Hey, what's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast. And today we're going to be talking about the Roth conversion window. All right. So prospective clients, existing clients, we get this question all the time. Hey, Kevin, when should we begin converting our traditional IRAs, traditional 401ks over to Roth accounts? All right. And every situation is unique. All right. There's no blanket answer to this one, but I'm going to talk about this concept that we like to call the Roth conversion window and hope that kind of gets the wheels turning in terms of, hey, this sort of applies to me, or hey, that doesn't apply to me, or hey, this applies to me, but with this unique spin on it. All right. And I also will say, listen, every situation is unique, okay? Just because you have a Roth conversion window doesn't mean you should aggressively convert those assets to Roth in every case, okay? Or fully convert your traditional IRAs over into Roth. Consult your own tax professionals, consult your own advisors before making any decisions. And okay, if you want to engage with my firm, if you want to work with us one-on-one, we'll drop links in terms of how to engage with our firm on that one, okay? But this video, hopefully this helps sort of clear up this whole idea of required minimum distributions, how those work, how that impacts your taxes over during the duration of your retirement, and ultimately, hopefully this helps answer this question of when should you begin converting your traditional assets over into Roth. So let's jump into the whiteboard here. And by the way, I am working from home today. My wife was sick all weekend. She's got the flu. She's sort of on the mend a little bit today, but after dropping my oldest son to school today, my twins also are sick. Okay. So they are both running fevers. So I've got the monitor here. All right. So I'm kind of monitoring my twins. That's why I'm talking very low. All right. So hopefully the audio is coming through on this one. And, let's learn something here. All right. So first of all, let's talk about the beginning dates, okay? These required beginning dates for RMDs, okay? So RMDs, turn my pen on, that would help. So RMDs, that's not a good color. RMD stands for required minimum distribution. Okay. And the beginning dates have changed over time. So all of you young bucks out there may not remember that the RMD age used to be 70 and a half. All right. And this is why QCDs, qualified charitable distributions, that's why the age in which you can begin making qualified charitable distributions is also 70 and a half. They used to sync up. Now with the Secure Act 1.0, 2019, 2.0 in 2022, they've changed all that. Okay. So they've kind of caused a little bit of confusion on this one. Not surprising. Okay. We're dealing with the government. Okay. They love confusion, but I'm here to clarify this thing. All right. So if you were born 1950 or earlier, you've already started RMDs. Okay. You began RMDs either at 70 and a half or at 72. Okay. And this is simply, the IRS, they have a life expectancy table that's published online, and there are different tables out there, but most of you will fall within the uniform life expectancy. Okay. In which they calculate, hey, how many years are you expected to live based on your current age? Okay. If you were born between 1951 and 1959, your beginning date is 73. All right. So this is, some of you out there are still in this situation where your beginning date is going to be age 73. But what I'm going to hone in on is for all of you that were born 1960 or later, and frankly, even if you were born between 1951 and 1959, you can probably learn something on this one as well. But if you were born 1960 or later, your beginning date was pushed out to age 75. So you've got a little bit more room. You've got a larger Roth conversion window, which we're going to talk about here in just a second. And just for frame of reference on this one, the RMD, when you do that first beginning date, it's sort of right around this 3.65% of your account balance. So if you have $1 million portfolio, okay, that translates into about $36,500 in which you're required to take out that first year in which you turn either 73 or in the future in 75. Okay. So, just from a planning perspective, just kind of think about this. Let's say you're lucky enough, you've got Social Security. Let's say you also have a pension, a pretty healthy pension. Maybe you worked for the military or the federal government. Okay. Maybe you're a firefighter, maybe you're a police officer, whatever it might be, teacher. You might have a nice healthy pension coming in where you've also accumulated some tax deferred assets. You're like, I don't even need my RMD, or you know what? I don't need all of my RMD. Okay. But regardless of what you need or want, you're going to have to take out $36,500 that first year. Otherwise, you're going to be slapped with a 25% tax penalty. Okay, you don't want to do that, obviously. Now, the first one you can defer until April 1 of the following year. So you don't have to take it out that particular calendar year for the first one only. So why this matters and sort of why this would play into effect in real practice is maybe you had some large bonus payouts that last year. Maybe you're employed most of the year. You're like, hey, you know what? Next year, when I'm fully retired, I'm not going to have any earned income, or if I'm going to have very little earned income. Maybe you have Social Security, maybe you have dividends, maybe you have some taxable interest payments that are coming to you. But for the large majority of your income is going to go to zero or very close to zero. You might want to defer that first RMD until the next calendar year, even though you're technically required to take one this calendar year. Okay, but again, that first one you can defer, but the caveat is you're going to have to take two that next calendar year. So you're going to have to take the previous year's RMD and the current year RMD if you elected to delay that first one. But from a planning perspective, just run the numbers, sort of think through your taxable income changing over time, and that could drive your decision on do you take it now or you delay that first one. Okay, but it starts off around 3.65%, and this thing just basically it's going to go up over time. Okay, so this is it's kind of this steady eddy growth over time. So by the time you turn, let's say 80, 85, 90 years old, you're going to be required to take out 6, 7, 8, and up to 9% plus out of your account balance. Okay, because your life expectancy table shortens, and so therefore the amount you have to take out goes up based on a percentage. Okay, and so just kind of keep that in mind as we transition to this next slide, because this is going to sort of get the wheels turning in terms of, hey, how does this Roth conversion window apply to me, and when should you begin converting assets to Roth? So I'm going to go to this next slide. I brought up a real client scenario here, and this client is actually currently in the 12% tax bracket, the federal tax bracket. Okay. So income is, not super high, not super low, kind of average, if you will. But as you can see next year, 2026, it jumps up to 25%. Why did this happen? Okay. This was really interesting to me when I looked at this one. The reason this happened is because next year, the Tax Cuts and Jobs Act is set to sunset. So we are supposedly going back to the old tax brackets prior to the Tax Cuts and Jobs Act passing in 2017, or actually, I guess officially coming into law in 2018. Okay, so for most individuals, most U.S. taxpayers, taxes are going to go up. And so for this individual, that actually pushes their bracket, or this couple, I should say, pushes their bracket to 22%, which is the current level, but it's going to revert back to the old brackets, which is actually 25%. So it's quite a big jump from a federal income tax standpoint, up to 25%, but it kind of tops out here. And then look what happens. Okay. When he turns 65, he is set to retire. Okay, so his earned income goes down. He's going to start Social Security potentially at that point in time, and also take some distributions out of his taxable brokerage account, etc. So our projection is that his federal income tax bracket is going to drop to 15%. Okay, but look what happens over time. So this might feel good in the beginning. Look what happens over time. It kind of stays at this 15%, and then what happens here? Well, one of them, this is a married couple, is going to turn 73. So all of a sudden, income tax bracket goes back up to this 25% level. And then look what happens here. Then it kind of creeps up a little bit. Now we're at the 28% level. So all of a sudden we top out at the 28% bracket later on, because this is when spouse number 2, this is when they turn age 75, okay, based on their year of birth. So all of a sudden, even though they didn't need all of this income coming out of the portfolio, they only needed income up to this 15% level. They don't want to get hit with that 25% tax penalty. So all of a sudden, their taxable income jumps with RMD number 1 and then jumps again with RMD number 2. This right here, ladies and gentlemen, is what I like to call the Roth conversion window. Okay, look at these years. Look at these years when all of a sudden tax brackets go down for them at the federal level, and if they don't take advantage of this Roth conversion window, they're going to be topping out at the 28% bracket, whether they like it or not. And that could also potentially impact things like taxation of Social Security, like IRMA, income-related monthly adjustment amounts, which is essentially an additional tax you pay based on your income on Medicare Part B and Part D. Okay, so just keep this in mind, is that this Roth conversion window, it's a pretty solid window for about 8 to 10 years for this couple. Okay, some of you, based on when you retire, maybe you retired 60 or 61 or 62, you can have 15 years or 12 years or 13 years of very low taxation, and it might even be below 15%. Okay, your income might be way down. It might be next to zero. Maybe you're delaying Social Security. I did another video on this before. Delay Social Security while you aggressively convert your accounts to Roth. So maybe you're not even taking Social Security. So the only income you're recognizing is income from your taxable brokerage account, or maybe some small distributions from IRAs. So your income might be super, super low, and therefore your Roth conversion window might even be bigger. Okay, in terms of filling up more brackets. And so this is the key, though, is to kind of thinking through what bracket does it make sense to optimize. So for this particular client, based on our calculations and the software we use, it made sense for them to optimize this 28% bracket. So what we were going to do, not only at retirement, but even pre-retirement, we're going to begin filling up this bucket via Roth contribution. So instead of them contributing to pre-tax accounts, which they've done for a very long period of time, 90% of their assets are in tax-deferred accounts, which is like most of you clients. Most of you PFR Nation have saved the majority of your assets in tax-deferred. Maybe you're building up a small bucket into Roth. But for this particular client, instead of contributing pre-tax, because listen, we see the value here of filling up this 28% bracket or current level, which is 24%, filling those brackets up, and then so not only contributions, but also via Roth conversions. And we're going to do that for a period of time so that before they turn 73 and before the spouse number 2 turns 75, which is somewhere down here, as you can see, their tax bracket does not jump. Their tax bracket actually goes down substantially because all of a sudden in these years, we use that Roth conversion window, we've converted pretty much all of their assets over into Roth. Not all, but a good majority of those assets into Roth. And now all of a sudden their income tax bracket is smooth for the duration of their retirement at 15%. As opposed to the previous situation where they had a very small window of being at 15 and then it tops out at 28% for the majority of their retirement. So this is what we're talking about here with looking at those areas of opportunity. And again, it may not happen at retirement. It could even happen right before retirement or the early phases right before you retire. But for a lot of you, it's going to happen when you ultimately do fully retire and your earned income goes down to zero and your only income is maybe passive income or Social Security income. Maybe you have a pension, maybe dividends, maybe capital gains. Okay. There's your Roth conversion window. And if you miss that window, you're going to be subject to high taxation, most likely for the majority of retirement, which most of you don't want to do, let alone thinking about the impact when these assets pass on to your heirs, thinking about the impact of the 10-year rule, okay, which is essentially the change from the Secure Act 1.0, where it ultimately forces non-spousal beneficiaries, for the most part, there are some exceptions, to begin liquidating those assets within 10 years. So very, very important concept to really dial in. Again, work with a professional, talk to your advisor, talk to your CPA, talk to your planners, and say, hey, you know what? I've heard about these opportunities, this Roth conversion window. What does my window look like? And what tax bracket does it make sense for me to take advantage of that's ultimately optimizing my long-term plan? It's all about minimizing your lifetime taxes paid. It's not about deferring taxes. Love CPAs, love tax professionals. They're brilliant individuals, but they were trained to defer. And this is the issue when you defer. All of a sudden you get stuck with high taxes for a very long period of time. And the reason is because people are living so long. Okay, most people, if you retired 20, 30 years ago, you're not living until 90, 95 years old. Okay, but a lot of you PFR Nation, a lot of you are savvy individuals. You're not only taking care of your finances, but you're also taking care of your health, your physical health, your mental health. And modern medicine, by the way, is getting more advanced. So most people are living well into their 80s, if not even their 90s, or even topping out at 100 plus. Okay, so you need to think through your lifetime tax bill. It's not about just defer. It's thinking through lifetime taxes and when are your brackets going to be at its peak, when are your brackets going to be at the bottom, and how can you take advantage of this Roth conversion window to ultimately minimize your lifetime tax paid to the IRS. All right, that's it, everyone. I hope you all find it helpful. If you did, hey, make sure to like the video. Make sure to share this with someone else who would find value in this. Someone who's over the age of 50, approaching retirement, not an underachiever by any stretch. Most of PFR Nation, I like to talk about PFR Nation. Most of our clients, most of PFR Nation have accumulated north of 7 figures. A lot of them are approaching mid 7 figures, upwards of 8 figures of assets. And the majority of those assets are in tax deferred vehicles. And so thinking through this Roth conversion strategy, this Roth conversion window, is critical. So make sure to share that with someone else who would find value. And of course, make sure to subscribe to our channel. It helps us obviously continue to impact you, but also reach more people, which is what we love to do. But listen, if you're interested in working with my firm one-on-one, there's a link in the show notes or the comment section or whatever you want to call this. I'm still new to the YouTube deal, but there is a link somewhere that you can click. It's called the Retirement Readiness Survey. You can fill it out. It's just a brief questionnaire, a little bit about your situation when you're looking to retire, and I will respond with a personalized video of the area of opportunities that I see based on my 16 plus years of practice and helping folks plan for and execute a successful retirement. Or you can just visit my website, which is imaginefinancialsecurity.com. I will also link that below as well. Until next time, Kevin Lau signing off.